Our next guest says he is holding on to his positions until July, along with having more economic data on hand. That is when QE2 ends, and Washington hopefully will be closer on the debt ceiling and the budget. Nick Sargen helps oversee over $36 billion in assets as Chief Investment Officer at Fort Washington Investment Advisors. Nick, great to have you finally back on our program. So you say wait till July before you move, right?
That's correct, Betty. You know, as your previous reporter indicated, you called it we're at a crossroads. I call it we're at an inflection point. We have this slowdown in the U.S. and around the world. And what we don't know, is it temporary or is it ongoing? And I think we're going to have a better idea in July. You know, one of the things is the big disappointment was the employment report that came out for May. So you're going to start off July with another employment report. What I want to see is, do we get a number like 175 or so, indicating a bit of a bounce back? The people who tell me it's all Japan related, the slowdown, well, we're supposed to see a rebound in auto production. We'll see. And then we're going to get the earnings reports for Q2, and they've been holding up, and that's still my reason for not selling at this point. But then, as you say, we've got the policy issues, end of QE2, and then the budget deficit.
Nick, what's your gut telling you, though, that you're likely to do and see in July?
You know, there's the head and the heart. I would say that I'm still hopeful of the temporary story. And, you know, as I indicate, I think what really took the wind out of the sail was such a disappointing employment report. But then I look and I say we had three previous numbers that were pretty solid. I tend to be a person that says, let's take a moving average. So I am hopeful that we get the bounce there. I've been a bull in terms of the earnings reports, so that's what has me keeping the faith. The part, though, that you know, is concerning. Take QE2. When the Fed launched it or announced it last August, that's when we were even worse shape than today. And then the market went on a tear, Betty, up 30% to the highs. And so we've retraced 7. But I think QE2, it's debatable whether it had any economic impact. There's no debate. It helped risk assets. So if it moves to the sideline, I don't think the outlook for risk assets is as good.
It actually seemed to help the stock markets, but not so much the bond markets, right?
Well, Betty, there, not so much the Treasury market, and that was where all the focus was. But again, I mentioned risk assets. So on the bond market, what am I looking at? I'm looking at what was happening to high-yield bonds, mortgage-backed securities, and the like. And after the Fed announced QE2, you're correct that the Treasury yields actually went up. But what we had was a compression in spreads for the risk assets. Now, in the last couple of weeks, that's begun to reverse amid the nervousness about the economy and the end of QE2.
Nick, as I understand it, you have actually, you hold quite a bit of financials, right? You actually think they're cheap now.
Yes. Yes. And, you know, Betty, the story there is, you know, I huddled with our portfolio managers last week. What you should know about our investment style. We're long-term value investors. So we're always looking, where do we see cheap stocks? And, you know, there's just no doubt if we do it on long-term valuations, the financials look cheap. But when I'm advising clients who have different persuasions, you know, I tell people, I say, look, they may be cheap for a good reason. You have the uncertainty about the capital requirements. That won't go away. But we're willing to be patient. And I'd flag for you, last year, we had an overweight in healthcare. It was a sector out of favor. And this year, it's been one of our best performing sectors. So you have to have that long-term patient orientation.
Right, and I find it very interesting, Nick, because on the one hand, you know, you say that, you know, there is uncertainty. We're in an inflection point with the economic data. On the other hand, the valuations are just so attractive in financials, you've got to be in them. So regardless of what happens in the economy, you're making a call, basically, on these banks. Despite what's happening,
that's correct. We're, you know, and you had asked the question. Well, they're down, but is the bad news in the price. And that's, in effect, what we're saying is we do believe that they've been so hammered that most of the bad news is priced in. Now, you know, a lot depends on the capital requirements. We're more on the side that the increase isn't going to be at the upper end of the range that Trujillo had, you know, the Fed governor had spoken about 2 weeks ago. Obviously, if we're wrong on that, the sector is going to get whacked even more.
Nick, great to talk with you as always. Really appreciate it. Nick Sargen.
Thank you.